Hi, and welcome to the third volume, the third issue, if you will, of the Macro Matters podcast in season 2023. My name is Rich Excell from the CFA Society and from the Gies College of Business. And once again, I am joined by my colleagues and co-hosts, Monique Thanos and Tony Zhang, my colleague at University of Illinois. Thank you guys both for joining me today.
Hi, Rich. Hi, Monique. Yeah, definitely. This is a lot of interesting things happening over the past 2 weeks, especially today, just right after the Federal Reserve announced their new policy rate, right?
Absolutely, and that's what we're here to talk about today. We want to talk about the Fed. We can't talk about the Fed without talking about some of the things that have been going on with the banks, et cetera, and we'll get to all of that. But first, why don't we talk about the Fed? And I'm going to share some slides, so those on the podcast will talk through what's on the slides, and then those on YouTube can see it. But I wanted to share some of these slides because I think there's some interesting price action going on in the various markets today that is somewhat helpful and indicative of of different things that were kind of going on in the market overall. So here we go. Sorry. So the first thing I wanted to point out and ask you guys about is if we look at the first interpretation of what came out from the FOMC meeting today, and I'm looking at the WIRP function on Bloomberg, which shows the what the market is expecting in terms of rate hikes or rate cuts for the rest of the year. And I've got side by side two pictures here, one from yesterday and the other one from today, right after the meeting. And so if we look as of yesterday, the market was pricing in about maybe 1.5-ish cuts. 1.5-ish hikes through May, and then cuts through the end of the year, which would amount to bringing that rate to the end of the year somewhere around 4.4-ish. And now after the hike today, what we see is about not even quite one hike priced in May, a little less than one hike, and then we have almost 3 cuts priced in to take the rate down closer to 4.2 by the end of the year. So looking at this, this is the Fed funds futures, et cetera. The short-term interest rate market seemed to get a lot more dovish after the FOMC announcement and the initial press release. At least that's what I'm seeing. How did you guys see that? Monique, what do you think? How did you kind of interpret that reaction?
So after the meeting, even during the meeting today, I mean, there was the feeling that we may be pausing, but of course we have to wait and see based on the data. I think that we were able to contain the financial stability for this couple of weeks, or the bank's crisis, but hopefully this is not going to have a spillover. So there is some other concerns about tight credit conditions now, and these could replace, depending on what happened, this could replace the increasing rates. But again, it's waiting to see based on the data.
Yeah, and if we go back, if I were to take this back 2 weeks ago or so, before all of these kind of Silvergate, Silicon Valley Signature, everything that begins with an S started to go out of business, we would see that Jay Powell had been effective at pricing in a terminal Fed funds rate much closer to 5.5%, and there were actually no cuts for 2023, or very, very slight cuts priced in for the rest of this year. So he'd gotten the market a lot more hawkish. And so even up to the date yesterday, things had changed quite a bit. So over those last 2 weeks, Tony, the short-term interest rate market has been consistently getting more and more dovish in terms of Fed policy, and that continued today. And when in the past, when you've seen the interest rate market get more dovish, what does that kind of usually lead you to want to think about, particularly like when we took like equity markets or styles or things like that?
Yeah, Rich, I think that's a great question. Typically, a lot of investors, when hearing this kind of a news, especially when hearing the dovish remark from the central bank, they always think about that right now, it's really time for them to actually take the risk on over the equity market. And that seemed to be the case over the past few days. And now investors or market sentiment had to shift dramatically from pessimistic to overly optimistic over the past few days. They actually took the collapse of the Silicon Valley Bank as one of the indicators that central bank would take a pause on their path to continue to hike interest rate. However, this has turned out to be always not to be the case. If we remember what had happened back to last financial crisis in year 2008, right? When Lehman Brothers actually failed at the beginning. It was actually just the beginning. It's not even at close to the end. It's not the end of the beginning. It's actually the beginning of the end, right? So
Yeah.
this actually is telling us this like market maybe overly estimated about what could potentially go wrong. As what we have seen over the past 2 weeks, through the interview or the conference from the Federal Reserve chairman today, that actually the investigator or has actually the supervisor from the board has already been to the Silicon Valley Bank right before the things went wrong, but things still happen. That's telling us that this is still a lot of the issue that have been embedded somewhere into this banking system, even though they continue to call the banking system is so sound and resilient, which could be the case. However, what about at the corners that people had been underestimated? Like Silicon Valley Bank is one exception. This is really, it just happened to be exception. Now it's because there was a high concentration of the depositor who actually tried to take the bank run at the same time, which actually caused this kind of issue, even though maybe initially it looked fine, right? This is supposed to be having a huge asset. We are talking about, no, we're not talking about 1 billion or 2 billion. We're talking about 100 billions dollar assets for a bank. It's supposed to be safe, but actually it still went wrong. Now, as what Monique said today, when Yellen comes in and kick in and say that right now the regulatory agency is not looking to provide the blanket deposit insurance for all of the uninsured deposit. So this is actually could actually serve the potential issue. I mean, the saving of what had happened of the Silicon Valley Bank has caused the balance sheet of Fed Central Bank to increase. Now, today, he apparently offers some of the explanation to the market, say, hey, don't look at the increase of the bank balance sheet as a sign that we're actually going to take a pause. Instead of doing a QT, we're actually doing a QE, right? So don't underestimate it. Don't misinterpret our stance. However, that's actually serve as indication that this things it's not over yet. And I want to come back to your graph here. This is amazing. Now here, this is show how the market would try to interpret that the Federal Reserve is going to take the more of the rate cut right at the end of this year. What if the things goes wrong? There are a lot of right now potential issues for things to go wrong, because from the growth and value sector performance, the divergence almost have gone to 3 standard deviation. If you look at Russell 1000 growth performance versus Russell 1000 value performance, right? Right now, the return, the year-to-date return divergence between them is larger than 10%. This is almost compared to what had happened in year 2020 when the pandemic started to break out. Now, this is also another things issue. Now, really, people really worried that what if the Federal Reserve if it's going to take the rate cut later in the second half of this year? What if they don't? Now, we are going to see a lot of investors invest in making their investment decision based on some kind of assumption which are very aggressive, right? This is the issues over here. After today's event, we see that there are 50% chance that Federal Reserve is going to hike the another 25 basis point in May 3rd event, as what you had already pointed out here. There's 50. Now, if we look at the December 13th over there, we see even today, the market anticipated the central bank would cut the rate faster than anticipated. This could actually pose some kind of issue, right, Rich, Monique?
No, you're absolutely right. And there's a lot you said there that I have some pictures I want to show and I want to unpack and get into further. But before we do so, Monique, you and I were talking beforehand about this idea that, you know, a lot of people in the market think that the Fed should use interest rates as a way to save the banks. But what we were kind of talking about is, you know, the Fed has many other tools to use. You know, interest rates it uses to look at price stability and full employment. But when we think about how it can protect the banks, there are other things that it can use. For instance, the bank term funding program that was announced last May. You know, we talked about potentially could they offer more insurance for deposits, but you know, do you think that many people in the market think that it's only interest rates that the Fed can use to help out the banks right now?
So, well, so there are two things, right? So the interest rates, we're just trying to control inflation here, right? Now, because of that, we end up in a situation that we may see the consequences of this financial stability, all the interest rates increasing. It's more like the tight credit conditions. So basically, these naturally, you could expect one thing affects the other, right? So now we're in a situation that we may see these tight credit conditions happening, and these naturally may affect the economy itself and the labor market, and consequently the inflation. So, but one thing that I wanted to say is, like, I know Tony is a little bit like worried, but there's a little bit difference between these and 2008, because if you think about 2008, it's more like the really big banks that was too big to fail and the whole big crisis. Here we're talking more about the smaller banks. And so there was more like a liquidity crisis here. I mean, we have all these interest rates super high. And so they had like some of this bank in particular, SVB, they were, in terms of risk management, apparently they were not doing the risk management, they were not hedging or anything. I mean, they knew, I mean, everybody knew that the rates were going up for a while. Now, did the rates go up too fast? Maybe. We haven't seen this happening. So maybe people, when you're in a bank and you're working on risk management, you have to also take into account that this year is a little bit different than in the past, that rates increase super fast. And most risk management models, they don't take into account this. So anyway, so maybe this is a local problem for smaller banks. So I'm a little bit more positive. I have my mind a little bit more positive that's not going to spill over to the big banks and everything, because they are well capitalized. Now, will people start moving, or deposits start moving too much to the bigger banks? Yeah, maybe that could happen too. There'll be a little bit more concentration to a big capital in the bigger banks. So, but we'll wait and see.
Yeah, I would agree with you. I don't see this as being a systemic issue at all, because I think when we think of just that bank balance sheet you're talking about, and we know from the CFA exam, et cetera, that, you know, assets equals liability plus owner's equity, right? And for a bank, that means loans and investments equal your deposits plus your bank capital. And in 2008, the problem was the loans, and we didn't know what the value of those loans were, and those loans were collapsing very quickly. And so we had an issue where we had, we had about for $1 billion or $1.5 trillion in terms of assets. We didn't have, we were seeing those loans kind of get written down. And so next thing you know, we had 1.3 trillion in losses and 1.5 trillion in capital. And so the losses were racking up much faster than the bank capital. Here we're talking something on the order of 500 to 700 billion maybe of total of deposit flight. And we've got 2.2 trillion in bank capital in the banking system.
Exactly.
So the banking system's in just an order of magnitude safer, and there's not nearly as much leverage as there was. But all of that said, banks, the banks that are struggling, the small and mid-sized banks that are struggling to hold on to deposits, if they don't have these deposits, that means that they won't make loans. And if they don't make loans, that means that small businesses won't get loans, and small businesses are the engine of growth. And so growth should be expected to slow down. And even Chairman Powell referenced the expectation of growth slowing down. But I wanted to get into the next slide here because Tony, you mentioned a little bit of the balance sheet, and the Fed had been working at about reducing the balance sheet by 95 billion a month, and it had brought the balance sheet down something on the order of $500 billion over the last 6 months or so. But it's gone up about 400 billion in a very short period of time here.
Very
now,
true.
This is not the total size of the balance sheet, which is somewhere on the order of $8.5 trillion. What I looked at here instead on this graph is I looked at the size of the Fed balance sheet as a percentage of GDP to kind of put, to put in the context that the Fed balance sheet is always growing and has always grown. It grows usually commensurate with GDP, right? As GDP grows, the Fed balance sheet grows, et cetera. And we can see at the bottom of this chart, from I would use the last 30 years or so from 1993 basically to 2008. It looks like a flat line on this chart because the Fed balance sheet was growing, but as a percentage of GDP, it was staying somewhere around 5 or 6%, right? It never that percentage of GDP was fairly constant. Then in 2008 we saw a spike. It on a percentage of GDP basis, it almost tripled to 15%. And then at one point with the various QE programs, it got up to 25%. And then, as we were going into 2019 and before COVID even started, the Fed had reduced that down to 20%. And if people remember, we were looking at a recession in 2019, even before COVID ever hit, right? COVID really just accelerated a lot of the economic weakness. And of course, COVID comes in and, next thing you know, the balance sheet spikes up to over 35%. And so now the Fed is talking about trying to bring this down. And I think, as you referenced, Tony, Chairman Powell talked more about the idea of credit tightening than quantitative tightening, right? Which is a reference back to what Ben Bernanke said back in 2008. He was talking about the composition of the balance sheet. So yes, the Fed is loaning money to banks using their collateral on these term loans, and so that's going to grow their balance sheet. But they're still going to try to bring down the long ends. And so remember when we had that kind of, I forget, they're selling long and buying, and buying short, if you will. And so there's a bit of a yield curve effect, and there is more of a magnitude effect. But, how should we be thinking about, either one of you feel free to ask, how should we be thinking about the potential for the Fed to be changing the composition of his balance sheet and having that effect on the economy? Any thoughts on that?
Yes, Richard, I think you already covered many great points. There's no doubt about that. So when I think the Chairman Powell, when he actually referred to right now the tightening the credit window condition to maybe to the family and to the business, which actually they might see this kind of a create a window for them to see some kind of a difficulty going forward for the next couple months, next half year. So that's why he was saying that both the Federal Reserve is waiting for data to show up. This is not a problem. The problem is that right now if everything that the Fed Central Bank has done has based on the data, that they should continue to do this based on the data, not based on some kind of an event or something that unexpectedly happened that could actually change it around. If they change it around, that could actually give potentially wrong signal that what market might be anticipating. The market is very efficient in terms of digesting the new information, but we don't want actually the central bank, from the investor perspective, to continue to change their stance, right? Look at it. When we actually discussed about the macro matter at the same time last year, we would never anticipate that the interest rate will be around 4.75% right now, right? Oh, yeah. Incredible. Now, after about a year, when Federal Reserve say that we don't anticipate to hike interest rate, like even at the end of the year 2022. Now here's just a couple months into year 23rd, we have reached to a level that unprecedented before, that caused the failure of Silicon Valley Bank, And they also caused the failure of another major bank, the Credit Suisse. We shouldn't omit or forget about what happened to Credit Suisse, right? Apparently we know that Switzerland's regulator took an unprecedented approach to wipe out the AT1 loan and trying to put a big package to rescue the Credit Suisse without actually uncovering what could potentially be a big systematic risk as we just discussed. Now, when we talk about the banking systematic risk here, well, if the question here remain unanswered, will Credit Suisse be the only bank who did the practice like this? I think they would they also suffer from either owning too much of long-term mortgage-backed security. But this is a very generic bank practice. Like they converted the short-term capital into a long-term investment. And when Federal Reserve raised the interest rate so fast, so within such a short amount of window, you can imagine this. We can see that the loss. I mean, from the short-term loss that for those kind of any institution who own this kind of a long-term fixed income asset classes, regardless. So that's why Federal Reserve came in and say, hey, we actually provide the liquidity to those banks. You can use those kind of fixed income bonds as a collateral at par. This is actually something had never happened before. If right now I have already suffered maybe 10 or 20% without taking leverage. Now here I can actually just use it as a collateral to borrow the money from central bank at par. This actually apparently potentially could solve a lot of a liquidity issue, but this will actually simultaneously promote the potential of moral hazards over there. What if you can actually save this time? What if next time would the central bank continue to cover the loss caused by maybe the weak risk management as from the senior management? Now this is
I
issue, right?
appreciate your point, and I think when we look at it though, I don't look at these as bailouts or moral hazard, because yes, depositors and some customers have been made whole, but the management teams have lost their job. The equity holders have been largely wiped out, and the bond holders have been wiped out. Credit Suisse is a little bit of a different animal. Having worked at Swiss banks and worked with the Swiss regulators, it wasn't surprising at all for me to see them zero out large global investors and to the benefit of Swiss consumers and Swiss depositors. So that one was a little bit democratic one, but I do want to move on, and Monique, I want to get your thoughts on this next one. And so again, when we're talking about the market and the market's perception, the Fed gave us their dot plots today, right? And the Fed doesn't see any cuts this year at all, as we can see on the far left. As I'm looking at the dot plot graph on Bloomberg, and it plots it, the dot plots themselves versus the Fed funds futures. And so on the far left, you can see that there are no Fed members that think there will be any cuts this year. In fact, there's some that still think that we could see rates in excess, close to that 5.75 to 6%. But the dots do show some cuts in 2024 to where the mean is somewhere around 4.25, which is what the market has for December of this year. So the market, again, as we can see with that white line, the Fed funds futures, is considerably more dovish than the Fed is. And it's probably not the right time for Jay Powell to want to tell the market it's wrong. But Monique, we've seen this before. When the market gets way more dovish than the Fed, Jay Powell has historically tried to, prove to the market that it's wrong. Do you think he can do that this time, or are there too many other things going on?
I think there are too many things going on. I agree that the market is a little bit more has a different view than the Fed, but there's a lot going on right now. There is a lot. They will follow the data and they will decide. Yeah.
But it does lead for potential for a lot of market moves if the Fed actually proves to be a little bit more correct than the market. So this was, when we see this dovishness and the market's perception that the Fed was being dovish, we saw that if we if we look at the price action of, I looked here on this chart, I have a daily chart of, or an hourly chart, if you will, of the E-mini futures, the E-mini S&P 500 futures, the Treasury bond futures, and the dollar index futures. And what we can see is at 1 o'clock, right after this announcement and the press release came out, for the better part of the next half an hour to 45 minutes, we see the equity market rallying, we see the bond market rallying, and we see the US dollar selling off. So that is, the market is reacting as if it really is interpreting what came out of the FOMC meeting today as being quite dovish. And so, I don't know what, when I certainly read it, I read everything after the fact, and I wasn't responding immediately. But when I was reading, I guess I wasn't reading things as dovishly as the market was reading them. Did you guys have any different interpretation when you first saw this news come out?
I agree with you, Rich. I think right at the moment when market actually went up after this information actually comes out, they really just try to think about that Federal Reserve has taken the financial instability into consideration. This is their interpretation. However, if we look at the dollar product that you just showed, now this is our saying here: don't fight the Fed, right? Is this still valid? This is a main big question. Is still valid? I think that given the situation, to the market condition, we shouldn't discuss any things without thinking about the market environment at the moment. Yeah, it's true that actually we did just emerge from the pandemic, and it is true that U.S. economy remained very strong. But however, the inflation, these other things we should actually take a look at, that the inflation remains very resilient right at this moment, especially in the non-housing service sector. That means those kind of blue workers can continue to ask for high wage regardless what had happened out there, right? This is also unprecedented. We continue to see the job layoff in the tech sector. Now, if we look at this, is what had happened in the tech sector. Tech sector turned out to be the best performing sector year to date. Rally, if you look at the performance of the NASDAQ, also the QQQ, significantly outperformed the S&P 500, which actually had a very mix of the value and growth stock and also banking stock together, significantly outperformed. Now, market just re-anticipated that Federal Reserve might be wrong. They say they might have to cut the interest rate sooner than anticipated. That's why the implied rate at the end of the year is much lower than the dollar prop. When I actually read the dollar prop, I say it's a very hawkish stance from the central bank. It actually remains over there, and it was reaffirmed from the Chairman Powell during the chair conference. He keep emphasizing that we actually take a stance to continue to fight the interest rate. We really want to affirm that we are going to bring the inflation down to 2% as target. They haven't softened the stance. So from that moment, I really want to identify what actually drives the optimistic sentiments within the market. And later on, it turned out to be this is not the case. The market realized, oh, okay, now apparently from the comments, also from the Yellen's comment, a remark, they are not going to back off all of the deposits. The market start to realize the risk. Then we actually start to see the financial sector, and those kind of long duration sectors, including the healthcare sector, continue to suffer. This is the situation. Yeah.
No, you're right, and that's the next slide I want to show. But you can see even on this one, at about 2 o'clock, when Janet Yellen was speaking, Secretary Yellen was speaking, giving her Senate testimony, and made those comments that you referenced. We see the stock market start to sell off, and we see dollars start to rally and bonds start to rally, which is this is more of not a dovish Fed move, in my opinion. This is more of a flight to safety type of move that we're seeing. And we can see this here. I put up, in yellow, this is the graph of the regional bank index, which over the course of the day, had been a little bit lower, but wasn't really doing much. It actually it kind of rallied a little bit, or tried to rally after those dovish, presumably dovish FOMC remarks. But I have the yellow line, vertical line there, when the news came out that Secretary Yellen was speaking to the Senate and said that there is no plan to have this national guarantee of deposits, which is actually something that Congress would have to do anyway, and the Treasury couldn't do that unilaterally. But this is when we see the regional banks sell off pretty sharply, like on the order of magnitude of like almost 4 or 5%. So Monique, we were talking about this before. I mean, so it seems to me that we're still at this point where the market is now really worried. The market is really focused on bank stability and financial stability, and isn't so much worried about inflation anymore. Is that how you see it as well?
So we saw that too. Basically, at first, that you have that feeling of being dovish. It looks like Powell is going to stop increasing rates. So there was a brief feeling of happiness or so, but then there was a comment from Yellen, and that affects, now comes instability of the bank. So we don't know what's going to happen in terms of that. So I don't see, like, just one comment, like, I don't see a lot of adding more rate hikes in this year, but there will be a lot of instability coming from the bank sector, probably. Not a big, maybe, hopefully not a crisis, but there will be more volatility. And I think what's happening because of that feeling that the Fed also doesn't know where we stand, because nobody knows if what happened in the past couple of weeks it's contained, right? We don't know what's going to happen next week. And I think the uncertainty, that's what brings stress to the market, and that's what brings that the increased risk of hard landing and recession and things like that. And I think that's why you see this flight to quality. That's when usually investors are worried, and the uncertainty, basically the uncertainty, you don't know. So if the Fed doesn't know, you don't know, nobody knows. That's what happens. So
no, and you make a great point, because I think for those that, and we remember COVID and COVID, and we saw the response from the central bank, and we saw the response from government, even in terms of fiscal and monetary stimulus. It was almost immediate, right? It was very, very rapid in terms of how quickly it happened by government standards, if you will. And I think most people are conditioned to think, well, that's how everything is going to be solved going forward. And the Treasury and the Fed tried to do that with their Sunday weekend kind of announcement on the bank term funding program, and it wasn't enough, and it didn't really appease the market. But those of us that were around back in 2008 can remember that it actually took several months, if not longer, for Congress and the government to figure things out. And they oftentimes would talk about programs, the market would get excited, then the program wouldn't go through, the market would get disappointed, then maybe it would go through, and then it didn't get implemented. And so that's what, Tony, you were talking before about how 2008, it wasn't the beginning of, it was the beginning of the end type of thing. And Bear Stearns was taken over in same weekend as Credit Suisse 15 years ago on that same March weekend, and the market rallied about 6% and then proceeded to sell off 50% because the problems were far from solved. And so I think you're right that if, to the extent that this is a deposit issue that has to be solved by Congress, and Congress hasn't really shown any ability to come to an agreement on anything, we probably shouldn't be overly hopeful that this is going to get resolved very quickly. And that means a lot of volatility, as you mentioned, Monique. So one other chart I wanted to show you, this is something I actually put in my LinkedIn today, because I've been having this debate with a lot of people that say, well, the market's forward looking. And so, yeah, you're saying there's going to be a recession, but as soon as we know there's a recession, the market's going to rally. And so I went back and I looked at the performance of different asset classes. And I know this is a particularly busy chart, so my apologies, but I looked at different asset classes over the last 50 years, and I looked at the Fed funds rate. I looked at the year-on-year changes of the S&P 500. I looked at the year-on-year changes of the Barclays Global Aggregate Bond Index and the Bloomberg Commodities Index. And what we see, for me, there were two takeaways on this. It's that, one, every time we have a rapid Fed rate hike cycle, we have a recession. We can look at that just about every single time. And so we've had a rapid rate hike cycle this time. There are a number of other indicators we can look at that suggest that we're probably on the brink of recession. But that one right there, I think, is fairly clear. But the other thing that stood out to me is that all of these asset classes, stocks, commodities, and the aggregate bonds, so it's not just sovereign, but it includes credit and municipals, et cetera. All of these asset classes actually sold off at the start of the recession, or maybe were selling off before that, but continued to sell off when the recession started. And yes, the stock market started to recover before the end of the recession, but again, it's not the, it's not the end here. It's the beginning, as you were kind of saying before, Tony. So, is there anything that stands out to me? I know I just kind of popped this on you, but this is something to me that's kind of interesting that, if we think there's going to be a recession, we should be realistic to think that there's going to be downside in some riskier assets at this point.
Yes, of course. No doubt about that. I think the recession will come. And as what have been indicated here from historical point of view, it will come. Now, the bigger question is, this is always the bigger question for the market, for the investor here. Number one is the extent, to which extent that the recession will look like. And the second is the timing. When will the recession come, right? Now, apparently, when the yield curve started inverted, that we should anticipate it roughly about 3 to 6 months, we should see a recession. But the yield curve has been inverted for over 6 months, longer than 6 months. We haven't really seen a recession kick in. We start to see some economic data weak. We start to see some inflation data start to soften. But from the GDP growth point of view, that we haven't really seen a sign of the recession coming in. Now, that's actually given hope to a lot of investors that we might have a milder recession, or we might not even have a landing, right? This is the narrative over the market has changed dramatically from having a recession to have a soft landing, or a mild recession, to no landing. That's why the market is performing so strong. Yeah, I think the Federal Reserve using the monetary policy trying to engineer a recession to contain the inflation. Not many tools that actually for central bank to actually think about. The interest rate apparently is the one of the most powerful weapons in his hand to actually to keep the inflation in contained. So this is last year, if we recall that during the congressional testimony, he actually pinpoint that to actually keep the inflation contained, that we might actually have to go through some kind of a pain and the loss in economy. That means we should anticipate to see some unemployment rate to go higher. That should happen, right? So this is some kind of there's some kind of a data that Federal Reserve is watching at, and the market investors are waiting to see as well. The job unemployment data and job non-farm payroll data are very key data to look at this moment.
You're absolutely right, and I think when you look at the yield curve, you're right that when it inverts, we know there's a recession after inversion, but it's always with a variable lag, and we don't know exactly when it will be. But what we do know is that lag becomes incredibly short once the curve starts re-steepening again, and the curve has been re-steepening, and that usually means a recession is much more imminent than when the curve inverts. One last chart I wanted to show you here is when we're talking about a recession, the likelihood of the recession is this is just a Bloomberg economics survey of the probability of a recession. And what we can see is it's somewhat binary if you really look at it, right? Most times it's somewhere around 0. Recently, it shot up to close to 100%. I'm not quite there yet. And it's had some head fakes, some fits and starts before where it would go up to 40 or 50 and then come back down. But as we've seen, every time it gets close to 100%, and this goes back for the last 30 years, every time this survey has gotten back close to 100%, we've had a recession basically almost imminently. And so this is the survey I've come up with. And again, Monique, you're the bull here on the call today. I'm not saying I'm not super bearish, but a recession is around the corner. But I suppose the optimistic view would be that perhaps it's just not going to be that long and not that deep. Is that right?
Well, that's what I'm hoping. I think there will be hopefully not, but my hope is that it won't be long and that painful. So I don't know if Tony shares his view, but that's how I feel.
Well, traditionally that we anticipated the recession could go away as very quickly, 2 quarters, right? That's the typical definition of the recession. Once the GPT slowed down and turned into negative for continuously 2 quarters, that we are going into a recession. In a recession, one of the bad things is that people will lose their job. They without the income, without a wage, that they are actually will be automatically cut off from their spending. That means they're going to lower the demand from the economy point of view. Now here, even without the recession coming in, if AI continue to evolve, continue to advance, like the introduction of a ChatGPT type of things, right? That this ChatGPT has proved to be a very powerful to replace most of the white collar jobs. Maybe as what we have discussed last time or the last couple of times, that you could actually replace some financial analysts, you could replace some coders. There are many people's jobs. So some group of people will be forced to go out of the market, regardless whether recession will come in. I think this is something that we can think about. This might be this allocation of the workforce, unemployment or employment, that we think about the recession. This is major difference right here. But I do, as Monique, what you point out, I do hope that recession will go away faster. And given the resilience of the economy right at this moment, we do see some hope that whenever recession want to kick in and the inflation will be contained, and after a short amount of time, we should see the economy to recover quickly. The faster, the better. We don't want the central bank to hold the high interest rate for such a stressful longer time than market anticipated. That's, I think, also part of the questions that are being asked for Chairman Jay Powell today, right?
Yeah, for sure. And Monique, I want to give you the last word, because one asset class I didn't put on any of these charts today was the cryptocurrencies, or the digital asset class. And I just wanted to get your quick thoughts. We've certainly seen a sharp rise in Bitcoin in the last several weeks. Do you think this is because of Bitcoin first came on the scene when we had the last banking crisis in 2008? Does this have something to do with the banking crisis, or does this have something to do with the expectation of the Fed stopping its rate hikes and maybe riskier assets doing better? Any thoughts on that?
Yeah, so the fact that the Fed was probably, maybe, potentially, let's say, stopping, that's of course it's positive for Bitcoin, for the entire crypto itself. But there's a lot going on still there. I mean, Bitcoin, I always see Bitcoin a little bit separate from the rest of the cryptocurrency ecosystem. I mean, it feels that Bitcoin already have established itself as a currency that all over the world that a lot of people are already buying, and even countries already investing on as a currency. So, I mean, some people compare it as the equivalent of a gold and things like that. So, yes, Bitcoin, it is something, it's strong, and I believe it's there to stay. And when we have crises in banks, and that's the reason why it was created, right? I mean, that's because back on the after the crisis. Now, for the rest of the cryptocurrency ecosystem, we're still going to see a lot of problems there, because there's a lack of acceptance. The technology is there, and the technology eventually is going to be absorbed into the traditional finance. But I don't know if you guys saw today, Coinbase got a Wells notice. So they're coming, SEC is going to come for them. And there are other companies with the same problem. So we're still going to have all these problems with the regulation and acceptance of the whole rest of the cryptocurrency. So it is to see, but yeah, I'm happy to see that Bitcoin is holding that strong, really strong.
And maybe we can talk more about that in a couple of weeks. But thanks, everyone. Thank you, Tony, and thank you, Monique, for joining me today. Thank you to all of our listeners who joined us for this special Fed session of Macro Matters, where we talk about the macro that matters for our CFA charter holder members and guests. Look forward to talking to you in 2 more weeks. Take care.
Thank you.
Yeah,
Rich.
thank you. Thank you, Rich. Thank you, Monique.